Well, broad-based Australian share ETFs have been the standout category this year, attracting some $4 billion in net flows, showing strong demand and diversified exposure to the local market. Let's get across why that's the case. Mark Choppy is the Senior Product and Investment Strategist at Global X. Mark, welcome back.
Thanks for having me again, Andrew.
Why are those ETFs doing so well at the moment?
Yeah, I mean, it is a traditional shift towards low-cost investing that we're seeing amongst Australian investors. Particularly this year, about a fifth of the flows, so $4 billion, has gone into Australian shares. It wasn't the same last year. A lot of the flows last year were going into international equities. Fixed income also got a little bit of a bid. But this year, we've really seen a flight to Australian equities. And the great thing about the Australian ETF market is there's a range of different Australian share ETFs. Index ETFs are doing a lot better than the active ETFs, and that's because, in my opinion, there's this movement towards low cost, and that's where we're seeing the bulk of the flows going.
It's been an issue, hasn't it, that those active funds have underperformed?
They have. I mean, the evidence suggests itself that active funds do a terrible job in terms of outperforming a broad-based benchmark over the long term, and of the funds that can outperform, only 2% can do it over sustained periods. And I think there definitely is not so much an active versus a passive debate, but really about this high cost to low cost. And if you look at the flows going into ETFs, around about 2/3 or just over 2/3 of flows are going into ETFs charging less than 0.25% per year. And you're starting to see a few active ETFs get a bit of success, but the reason they're getting flows is because you've got this low cost active coming out. And really, once you take out the so-called active alpha, if there is any alpha, you're really just left with market beta. So for investors who want to control for fees and control their own behavior, the gravitation towards low-cost ETFs is something that I see continuing throughout many years to come.
So, Mark, if you're looking to invest in an index, how broad do you want it to be?
It's a great question, Andrew. And when you're investing in Australia, you've got the top 20 companies, the top 50, top 100, 200. Most people gravitate towards the top 200. We believe a better approach could be looking at the broader 300 companies. Now, why is that the case? When you're looking a little bit broader, you get different sector exposures. You get exposure to more small cap companies as well. And if you have a look in terms of the year-to-date performance so far of the best performing Australian companies, some of the best performing ones are towards that lower market cap end. So you've got companies like DroneShield up over 300% so far this year. Catapult Technologies also up 70%. Domain up 70%. These are the types of companies that haven't yet migrated into the bigger 200 index just yet. So for investors who want to get a bit more broader market exposure, particularly now because a lot of investors think, oh, the top end is a little bit heavy, Australian banks are the most expensive in the world, getting that broad market exposure through the top 300 Australian companies could be an interesting way to play it.
Well, and hence then, Global X, you're launching a Australia 300 ETF.
We are, yes. There hasn't been an ETF that has launched in the broad-based Australian equity landscape in over 7 years. So we're really excited to be bringing this to market. So this is the Global X Australia 300 ETF. The ticker code for that will be A300. Nice and easy ticker code to remember. It's launching next week. We're really excited because this will be the lowest cost ETF in the market that tracks the broader 300 largest Australian companies listed on the ASX. And we just feel that we want to be more relevant to client portfolios. There's still a lot of money going into Australian share ETFs, and we want to be part of that. Generally, Global X has been known a bit more for a commodities expert, being the largest gold ETF in the world. We do thematics really well. This is just being more relevant. And the data speaks for itself that more and more money is going to Australian share ETFs. And we feel our analysis shows that investors from moving from high active costs and unlisted funds into lower cost ETFs could save almost $4 billion of fees. So the great thing about low-cost ETFs, like our ETF, is we'll be able to pass on those savings to consumers.
Well, I was going to say, is that a significant attraction for investors? I guess, but particularly new investors or young investors, they want those low fees.
They do, and it's not so much low fees. You've also got financial advisors, asset consultants who are building model portfolios, and fees are like termites. They eat into returns. So the more that you can exterminate those termites, the better long-term returns you can have. Tax is also a consideration as well. So ETFs are tax efficient, they're liquid, so your after tax and after fee return could be enhanced through these low cost wrappers. And we want to be, as you said, relevant. There's a whole bunch of new investors trying to get into the market. People looking to invest in property might see it as a bit unattainable. A great way to kind of leverage the impact of the share market is by investing in these ETFs. With a click of the button, you can get access to a broad range of companies. So we're very bullish on this type of asset class overall and of the future of ETFs going forward in the Australian market.
Mark, am I right in saying, certainly around COVID, post-COVID, when we saw that massive injection, that ETFs really took off, particularly courtesy of a lot of new investors who saw ETFs as the best vehicle to enter the market? Is that now broadened, perhaps, that we're now seeing more retail investors, in particular in Australia, opting to go via the ETF?
100%. And this year we've taken in over $21 billion in terms of ETF net flows. We're going to smash the record we saw last year, which was $31 billion. So I reckon we'll probably hit closer to 40 to 50 billion in net new flows this year. And it's not just in Australia, it's happening all over the world. ETFs are, the direction is very clear, ETFs are the preferred vehicle. So yes, we're seeing it amongst retail investors. They account for around about 10 to 20% of flows going into ETFs, but it's really the financial advisors building portfolios and using ETFs to construct those low-cost pillars. That's also generating the bulk of the flows overall. So yeah, since COVID, we did see a huge spike. 2022, a little bit of a drop-off, but over the last couple of years, and especially this year, it's going to be a record-breaking year for ETFs.
And which are the most popular thematic ETFs at the moment?
So far, we've seen a lot of interest in our defense technology ETF, which is DTEC is a ticker code. It's been one of the best performing ASX-listed ETFs on the market. And why that is the case is you've got these massive companies who are really going off the tailwinds of this 5% NATO agreement to be spending on defense. But generally, it's actually going to go about 1.5% is going into non-threatening types of defense companies. And that's where technology really plays a part. The other thematic that we're starting to see also a lot more traction in is artificial intelligence. It is a bit of a buzzword, but artificial intelligence is moving from this experimentation phase into this execution phase and then into the monetization phase. And a lot of these companies are really driving for meaningful earnings. You're seeing a lot of companies invest their capex within the AI space. So between companies like defense tech, between companies like artificial intelligence, and even we've bought out our Chinese tech ETF Dragon, DRGN, seeing a lot of traction in that economy as well, moving away from the traditional finance and property side into these tech and AI leaders.